Japan's government owes more money than any other developed nation, over twice its annual economic output. Yet it continues to function, with government debt exceeding 260% of GDP. Japan is running the largest monetary experiment in modern history. Conventional economics suggests this should have collapsed decades ago. But Japan keeps defying gravity. How is this possible? And what happens when the world's third largest economy can no longer sustain the unsustainable? The sheer scale of Japan's debt mountain is staggering. At over $13 trillion, Japan's government debt is larger than the economies of Germany, France, and the United Kingdom combined. To put this in perspective, every Japanese citizen effectively owes over $100,000 in government debt. The interest payments alone consume nearly 25% of the national budget, creating a vicious cycle where the government must borrow more just to service existing debt. The roots of this crisis trace back to Japan's lost decades, beginning in the early 1990s, when Japan's asset price bubble burst. Property values collapsed by 87% and stock markets fell 80%. Rather than allowing painful restructuring, the government chose to stimulate the economy through massive public works projects and bank bailouts. This temporary relief came at the cost of accumulating debt that would compound for generations. Enter Abenomics. Prime Minister Shinzo Abe's radical three-arrow strategy launched in 2012. The plan combined massive monetary easing, flexible fiscal spending, and structural reforms while initially boosting stock prices and weakening the yen to help exporters. The program failed to achieve its 2% inflation target for years. The real legacy of Abenomics was normalizing unprecedented levels of monetary intervention. The Bank of Japan has become the ultimate enabler of government spending. Through quantitative easing, the BOJ now owns over half of all Japanese government bonds, essentially the government lending money to itself. This creates the illusion of demand while masking the underlying solvency issues. The BOJ's balance sheet has ballooned to exceed 135% of GDP, larger than Japan's entire annual economic output. Japan's demographic time bomb makes debt sustainability increasingly difficult. With 28% of the population over 65 and a birth rate of just 1.3 children per woman, Japan's workforce is shrinking rapidly. Fewer workers means fewer taxpayers to service the massive debt, while growing elderly populations increase healthcare and pension costs. This demographic squeeze threatens to unravel Japan's delicate debt equilibrium. Yield curve control represents Japan's most radical monetary innovation. The BOJ artificially caps 10-year government bond yields at around 0%, effectively eliminating market pricing for risk. This allows the government to borrow cheaply indefinitely. But it comes at the cost of destroying bond market functionality and creating massive distortions throughout the financial system. Japan's secret weapon has been domestic ownership of its debt. Over 90% of Japanese government bonds are held domestically, primarily by Japanese banks, pension funds, and the central bank. This insulates Japan from foreign investor panic but creates a different risk. The financial health of Japan's entire banking system becomes tied to government solvency. The global implications of Japan's debt experiment are profound. Other indebted nations watch closely, wondering if they can replicate Japan's model. The United States, with its own growing debt burden, studies Japan's ability to maintain low interest rates despite high debt levels. However, Japan's unique cultural and institutional factors may not be easily transferable to other economies. Japan's massive debt experiment represents either a revolutionary new economic model or the world's largest financial time bomb. The country walks a tightrope between maintaining stability and risking catastrophic collapse, as the global economy faces its own debt challenges. Japan's 3-decade experiment offers both warnings and potential roadmaps for navigating an increasingly indebted world.